All right, here we go. So, wanted to talk about money. If you want to make more money or you're interested in building wealth, I think it's important to try to understand it, be a student of it. That's what I've been doing. I wanted to share this with you because I think for a long time I've heard the same number that real estate agents want to make. And in real estate or across the board, I think it's helpful to understand actually what's happening, how far my money goes, what is money, what's the Federal Reserve. Um, and the whole reason I'm doing this, because you may decide that you need to make more of it. And as we're starting the year off, setting goals, getting going, I want you to have the proper motivation that you need uh, to make the money you want to make, to live the life you want to live, to have the things you want to have, to enjoy the experiences you want to enjoy, and to build the future that you want to build. So this is for anybody in any position. But I think it's so important just to understand it. So, first part's a little bit dry, just talking about some facts, and then I'm going to get into how does this impact? What are the insights that I glean from this? So, just the history of the dollar. So, in 1914, the Federal Reserve was created, and it's a really cool story. There's a book called The Creature from Jekyll Island. Actually, some really prominent people got together at Jekyll Island. They were like the country's billionaires, the Elon Musk of our time, and banks were having a problem. People were going in and they were calling it a run on banks. They would withdraw all their money at the same time with bad news, and banks would just crumble. And what this did is it created a lot of ebbs and flows in the economy. Businesses would go in business and out of business. And so some of the biggest and brightest and most wealthy people got together and said, hey, we need to establish a central bank across the world. There were central banks in Europe that were already doing this. And so America, I believe it was the last nation to have a Federal Reserve or central bank. In 1944, the US dollar actually became the world currency, meaning that it's a currency that a lot of nations hold to stabilize their economy and to also give their currency value. And then in 1971, when the Vietnam War was going on, President Nixon actually decoupled the dollar from gold, meaning that it's no longer backed by gold, where $1 equals a certain uh, ounce or weight of gold. And in 71, that was decoupled. And what was happening is that the United States government was printing tons of money to try to pay for the war. Other countries were getting nervous. They were worried that their economies would collapse. They were worried that their currency would be devalued because gold it was pegged to gold as well. And so Nixon decoupled the dollar from gold and basically moved us into this fiat debt-based society that we're in today. So the Federal Reserve was created in 1914, and they have five primary functions. Um, they want to conduct the nation's monetary policy. They want to set direction or for what the policy should be as it relates to interest rates, um, all of those things. They want to stabilize the financial system, meaning they don't want um, there to be a run on banks. They don't want the interest rates to get out of whack. Their whole goal is to try to stabilize everything that's going on, and they use interest rates and quantitative easing, which is printing of money now, quantitative tightening, which is pulling money out of global supply or United States supply. They use those levers to impact the nation's economy. They want to promote financial institutional safety through regulation. So basically, think of it, the Federal Reserve as a central bank, and all the banks that you and I bank at, they are extensions. Well, they don't work for the Federal Reserve, but the Federal Reserve kind of controls their policy and what they do. They provide financial services to banks, meaning government, meaning lending, borrowing, things like that. You'll hear the president today talk about Jerome Powell and lowering the interest rate because it's costing trillions of dollars every month to service the United States debt. And as the interest rate drops, the amount of money it takes to service the debt goes down too. And then they want to promote consumer protection through supervision, policy research, and analysis. So basically, what makes you feel safe about putting your money in the bank, the Federal Reserve creates that policy and supervision. So they have three main goals. They want to minimize employment. So as employment goes up or down, they adjust interest rates and they quantitative ease or tighten to fire the economy up or really slow it down. So from 2021, 22, when we saw all of the COVID stimulus money be injected into the country and interest rates really dropped, people had more money, their money would go further. And because of that, they were able to buy houses. That's where we saw like prices going way up. We saw goods and services go way up. I know if like you go out to eat today, it's hard to take my family to dinner for less than $100. And a lot of that is due to inflation that was caused by pumping money into the marketplace. They want to stabilize prices. So in response to that, right, inflation shot up. And so what does the Fed do? They increase the interest rate, trying to slow the economy down, to make borrowing harder, to make it more expensive. And that slows things down, which should reduce inflation. And they want to moderate long-term interest rates tied to government borrowing, bank borrowing, even mortgage rates are tied to the 10-year yield. And so those are the three main functions of the reserve. So in 1971, we talked about the dollar breaking off or being not backed by gold anymore, and it shifted to a fiat currency system. Um, and it's basically based on the government strength of faith and credit. So you'll hear about treasury bonds and all of these things. That's what the dollar is pegged to today. And because of that, we've seen inflation increase since at a more rapid pace, more aggressively since all of this happened. And you'll have times of almost hyperinflation you did in the late 70s and early 80s. You hear people talk about buying a home and where they say, well, my interest rate was 16%. And that is true. Homes were also 50 or $60,000. And so there is a difference there. But inflation's harmful. And and we can thank our government for some of that, right? And it also impacts how far your money goes and what you do with your money. And that's really what I wanted to talk to you about. So, what is inflation? Inflation is the general increase of prices for goods and services over time, leading to a decrease in purchasing power of money, meaning the money you have just doesn't go as far. And they measure inflation, or the Fed does, United States government does, in two primary uh, terms. Consumer price index, which is the overall inflation, that's the measure of everything: food, clothing, healthcare, housing, energy, gas, oil, all those things. And then you have core CPI, which that excludes food and energy. Um, that impact long-term inflation. So this is what the Fed uses. They use core CPI because that gives a very narrow looking window. You can tell what it is this month because you're taking out the food and energy, which will impact inflation for a long period of time. So core CPI is what they use to gauge what they should do with the rates. Also, they use unemployment as their other big measuring tool uh, that gives them permission to raise or lower the rate. You also may hear of debasement, and it's the intentional reduction of a currency's value or purchasing power. This leads to inflation, reducing purchasing power, economic instability. So in the old days, when you had a coin that was made with gold or silver, um, to make that less valuable, they would basically mix that with cheaper metals like bronze or something else. Um, or they would make it smaller, physically shaving the metal down, clipping or plugging, reducing its value. In today's terms, central banks they'll increase the supply of paper money, which is quantitative easing. You may hear say, well, the printers turned back on. They're injecting money into the economy. That means they're printing more dollars, and when they print more dollars, every dollar you have is worth less. Um, all this is in an effort to control the growth of the economy, to reduce unemployment, to fund the government. But it does lead to inflation, a reduction in purchasing power for individuals like you and I, and it can lead to economic stability. Think of the Great Recession in 2008 and 9. Um, Money was being printed then as well, and borrowing rules and regulations were less stringent than they are today. And it got out of control, right? And you had this huge housing bubble that popped. Um, and so these are all negative things that inflation and debasement can cause to the actual currency. So, what does all this mean? I just wanted to give you a brief background because you're hearing these terms. I want you to be able to talk about them intelligently, to go and study them, to just use this as a spark to go and learn more about it. But basically, since the 70s, when the dollar was decoupled from gold, the red line is cumulative inflation, and the blue line is the purchasing power of a dollar, right? And whether you can read these charts or not, what you will see is that inflation has increased rapidly, almost 700% since the 1970. And the value or the distance a dollar will take you has been reduced drastically. It's almost identical, right? The curves are one's inverted, one's not. The thing about inflation is you hear about, well, the United States core CPI was 2.9% last month, less than expected, so they reduced the rates. That's month over month or quarter over quarter, or even year over year. But really what happens is when something becomes 3% more expensive today, we never really get that back unless there's a major event like the housing recession, right? We know that real estate appreciates 3 to 4% year over year, right? So that means it's 3% more next year than it's worth this year. Um, and one reason real estate's always been a great hedge against inflation because it's matching the CPI or core inflation, which is typically 2 to 3%. That's the Fed's target year over year. But what I want you to take away from this chart is that since the 70s, inflation has increased and the value or the the weight, the purchasing power, the distance you get out of a dollar has drastically decreased. So what does all this mean? Is inflation, it's cumulative over time. We measure month over month, or the Fed does. That's what you hear. But ultimately, it's cumulative and it keeps stacking up and keeps going. So our dollars go less far today because of inflation. We get less for each dollar today than we got yesterday. I thought these were just very eye-opening numbers. And so this is since 2000. And I use the word the $100,000 value because every real estate agent I know, when they get in the business, they want to make 100 grand. They want to make 100 grand. And that is a lot of money. Um, but since 2000, the same equivalent to today's dollar, $100,000 in 2000 in the year 2000 is equal to or has the purchasing power of $188,000 today. So if an agent's getting into business in 2000, they said they wanted to make 100 grand because of inflation, because of the value of the dollar being less, you would have to make almost $190,000 today for that money to go just as far. So your quality of life in 2000 for 100 grand is almost cut in half to what your quality of life in 2026 is for 100 grand. Here's another chart that shows the buying power of $100,000 over time. So basically, $100,000 would get you X amount in 2000 is equal to $50,000 of that same thing today. So if you had 100 grand, you might could buy 10 widgets in the year 2000. In the year 2026, you can only buy five of those widgets. So it goes less far. So, what do we do with all this information? Well, number one, I want you to go and learn more about it. I want to have conversations about it. I I think one of my fears is doing all this work that we're doing and having nothing to show for it, right? And so the only way I know to combat that is to learn, to educate myself, um, and figure out how do I shield myself from that. So the first thing, guys, we really just have to earn more money. And fortunate for most of you, if not all of you, is you have the ability to earn more money. You have the ability to earn more money year over year, and every year you should be trying to earn more and more money because inflation is making the dollar go less and less far. So if you made $80,000 last year, in the coming year, that $80,000 will get you 90% of the way that it got you this year. We have to earn more money. For us, that's doing more deals, going on more appointments, calling more people. But that is one way to shield yourself from inflation and to guarantee that you're actually outpacing inflation. Second thing is don't hoard cash. Cash makes me feel comfortable. I feel more secure when I've got X amount of dollars in the bank. And I do think there is a certain part of liquid money that we should have, whether it be in an interest-bearing savings account or something like that that's not risk. You're not at risk at losing it, but it's not just sitting there dead. Um, I think that's somewhere between 4 and 6 months of your living expenses, or your business expenses is what you need just as protection, just in case you get hurt or there's an injury or you have to quit work because there's an emergency. But that should be the first step is to get to that point. But after you get there, don't hoard the cash. You actually have to take that cash and buy assets with it. Otherwise, it's sitting in a bank account, becoming less and less valuable every day. Um, we have to put on our investor hat, take off our consumer hat, put on our investor hat, and actually make sacrifices to make investments in assets because an asset is something that doesn't lose value over time, right? A house is a great asset because every year in the course of the long term, it appreciates. Um, you could buy at precious metals would be an asset like uh, gold or silver. I don't know if you've been reading about that. It's shooting up, right? But all of those things, they're scarce. There's a finite amount of them. Land, there's a finite amount, and because of that, it appreciates over time. So you want to invest your money in assets and not just spend all your money consuming, buying things, uh, uh, just living, all of those things. Um, you want to use smart debt. We are in a debt-based economy, and I have learned a lot about debt over the course of this year. I encourage you to read the Banker's Code. Um, if you haven't, it'll just help you understand the model of the bank because really what a bank does is when you go and put your money into the bank, what they do is they take out a loan against the money that's all the deposits in there, mine and yours, and they lend it out and they actually make money with someone else's money, right? So we're in a debt-based society. The way that you grow your wealth is to actually use debt. I'm not talking about credit card debt. I'm talking about borrowing to buy assets, right? Borrowing to buy assets. And the fifth thing is just live on a budget, making sure that you have enough to buy assets. Every month, you should be buying some sort of asset, right? If you don't have enough money to be doing that, you should be saying, how can I make more money? How can I make more money? Um, and because you need to every month be plugging something into, you can put it in the stock market. You can put it towards real estate in the future if you want investment property. You can use that money to go and lend. That's pretty sophisticated, but you can also do that to make more money. But you want that money earning interest or appreciating in some type of asset. And the only way to do that is to have enough money to do it. That's what I wanted to share with you all about money because I know that the last 2 years for me, I've made less money and my cost of living hasn't gone down, it's actually gone up. right? So I've been squeezed. I've been forced to move money around. I've seen my reserve accounts dwindle down. And so the only response to that is to go and earn more money. For me, I need to go and earn more money so I can get back those reserves and I can continue to invest and buy assets and do things like that again in the future. And for some of you that you didn't make as much money last year, that is the answer, right? This is what should motivate and should drive you to increase your income goal, to want to make more money tomorrow, next year or this year than you made last year, to get into business with people that will pay you bonuses based on production or based on um, progress of the company, right? Um, you have to make more money if you want to keep up. We've been in a pretty inflationary economy for the last few years. It's cooling down now, but we don't get that back. Your food to go to dinner, it's $100 where it used to be 60. That may come back a little, but we're not getting all that back. And so every year it just takes more and more and more to live. And I want everyone that I'm in business with to know these things and to be motivated to go and earn more money so you can build the life you want to build. I hope this was helpful. I'm sending this out to you over the weekend because I want you to watch it. I want you to think about that as you think about 2021. I know next week is like the first full week for a lot of people. Um, but I want you to thrive. I want you to thrive and I want you to understand why you need to do that. So I hope you've enjoyed this. This is my first run at it. And so I'm going to learn this more and more and more. I'll probably go around and present it a little bit, but go make more money. You have the ability. You are in the industry where you are uncapped. Hope you go do it. Thank you for watching this.